Amazon did not simply beat expectations this quarter. It delivered one of the most unusual earnings reports in its history. Revenue reached $200.6 billion, up 20% year over year. More importantly, Amazon crossed the $200 billion mark outside the holiday quarter, showing that its underlying revenue base has moved to an entirely new level. The retail ecosystem remains enormous. Online stores generated $70.4 billion, while third-party seller services contributed another $46.8 billion. But the fastest growth came from the businesses with much stronger economics. Advertising increased 26% to $19.8 billion, while AWS surged 37% to $42.2 billion. That mix shift pushed gross profit to $104.8 billion and operating income to $27.5 billion. AWS alone produced $16.6 billion of operating profit, meaning one division generated more than half of Amazon's total. Then came a number that stunned Wall Street. Reported diluted EPS of $5.75, compared with an estimate of just $1.82. But this was not a normal earnings beat. Net income was lifted by $53.4 billion of other income, largely an unrealized gain tied to Amazon's investment in Anthropic. It is real under accounting rules, but it is not operating cash. And separating those two realities, record operating performance and a massive non-cash gain, is the key to understanding this quarter. Across the last 17 quarters, Amazon's growth engines have separated into two very different groups. The traditional retail operation is still expanding, but it has entered a more mature phase. Online stores compounded at roughly 8.5% annually, while physical stores grew just over 5%. The higher margin platforms are moving much faster. AWS compounded at nearly 21%, and advertising led the entire company at approximately 22.6%. That difference is transforming the quality of Amazon's revenue. Quarterly sales have expanded from $121.2 billion in Q2 FY22 to $200.6 billion today, with the holiday quarter already reaching more than $213 billion. But the most important change is not simply that Amazon is becoming larger. A growing percentage of every new dollar is now coming from cloud infrastructure, advertising, and marketplace services rather than inventory-heavy retail. That is why Amazon can continue expanding profitability even as its original e-commerce business matures. This quarter can be understood through 5 forces working together. The first is AWS. Revenue reached $42.2 billion. Operating income climbed to $16.6 billion, and contract backlog expanded to $496 billion. AWS is now running at an annualized revenue rate of approximately $169 billion, with AI demand driving its fastest growth in 18 quarters. The second force is Amazon's infrastructure offensive. Quarterly CapEx reached $54.2 billion, up 68%, while the full-year investment plan has risen to roughly $220 billion. Trainium, Inferentia, and the broader custom silicon ecosystem have already crossed a $25 billion annual revenue run rate. Amazon is effectively spending today to reserve the computing capacity it expects customers to need years from now. The retail machine is also becoming more efficient. North American revenue reached $116.2 billion. Amazon Business surpassed $60 billion, and faster delivery is now available across more than 2,300 U.S. locations. Advertising added another $19.8 billion. Because these ads are connected directly to shopping activity, Amazon can measure whether an impression becomes a purchase. That closed-loop system gives advertisers clearer returns and gives Amazon a high-margin source of capital. But the financial contradiction remains. Operating cash flow reached $161.4 billion over the last 12 months, yet free cash flow fell to negative $7.6 billion. Anthropic is lifting reported earnings. AWS is lifting operating profit. But the AI infrastructure build-out is consuming cash at extraordinary speed. Amazon's retail advantage is not based on explosive market share gains. It is based on holding a dominant position while the entire e-commerce market continues expanding. Amazon controlled roughly 34% of U.S. e-commerce in 2021. That share is projected to approach 37% by 2028. At the same time, e-commerce itself is taking a larger share of American retail spending. rising from approximately 14.6% of total retail sales to nearly 18.7%. Amazon therefore benefits from two forces simultaneously. It is gaining modest share, while the market beneath it continues moving online. The more important structural shift is taking place inside Amazon's marketplace. By 2025, first-party merchandise volume had reached approximately $255 billion. Third-party marketplace volume was already more than twice as large at $575 billion. That matters because Amazon does not need to own most of that inventory. Independent merchants carry the product risk, while Amazon monetizes transactions through commissions, fulfillment, logistics, and advertising. Amazon is increasingly becoming the infrastructure beneath global commerce, not simply the retailers selling the products. Amazon is now the world's third-largest digital advertising platform, behind only Meta and Alphabet. Its projected advertising revenue of approximately $82 billion remains far below the two industry leaders. But Amazon possesses something neither social media nor traditional search can fully replicate: direct evidence of purchase intent. Amazon knows what customers search for, which products they compare, and what they eventually buy. That makes its advertising inventory especially valuable to brands trying to connect spending directly with sales. The opportunity is also expanding rapidly. Global digital advertising is projected to grow from $539 billion in 2022 to approximately $1.27 trillion by 2029, representing a CAGR of more than 12%. Amazon's strongest position is in retail media, where it captures nearly 80% of U.S. spending. Walmart and dozens of other retail networks divide most of what remains. Retail media is also taking a larger portion of the overall advertising industry, potentially rising from 13% of U.S. digital ad spending in 2020 to 20% by 2029. Amazon is therefore not merely competing for advertising dollars. Its marketplace is helping redefine where advertising budgets are being allocated, and the resulting margins provide Amazon with one of its most important sources of funding for the AI race. AWS remains the largest cloud infrastructure provider in the world. It controls approximately 28% of the market, compared with 22% for Microsoft Azure and 15% for Google Cloud. The overall industry generated roughly $143 billion in quarterly infrastructure revenue, up an extraordinary 43% year over year. But market leadership does not mean competitive pressure has disappeared. AWS held approximately 34% of the market 4 years ago. Its share has since declined to 28%, while Azure and Google Cloud have continued gaining ground. This does not mean AWS is shrinking. Its revenue increased 37% this quarter. The problem is that its strongest competitors are expanding even faster inside a market being transformed by generative AI. AWS therefore faces a very specific challenge. It must invest enough to defend the largest installed customer base in cloud computing without destroying returns through excessive capacity and depreciation. The company still leads on scale. The next comparison reveals why scale alone may no longer be enough. AWS remains the largest and most profitable major cloud platform. Quarterly revenue reached $42.2 billion. Google Cloud reported $24.8 billion, while Azure is estimated near $26 billion, since Microsoft does not disclose Azure revenue separately. Oracle Cloud Infrastructure remains much smaller at approximately $5.8 billion. But the competitive picture changes when growth is considered. AWS expanded 37%, while Azure grew approximately 43%. Google Cloud accelerated by 82%, and Oracle's infrastructure business grew 93% from a far smaller base. AWS still dominates profitability. Its operating income reached $16.6 billion, producing a margin of 39.4%. Google Cloud generated $8.8 billion at a margin of 35.6%. Microsoft and Oracle do not provide comparable cloud-specific profit figures. Each company is also building a different technological mode. AWS is using scale, platform breadth, and its Trainium and Graviton chips to reduce dependence on NVIDIA. Microsoft combines its enterprise distribution network with OpenAI, NVIDIA GPUs, and internally designed Maya and Cobalt processors. Google integrates Gemini with more than a decade of TPU development. Oracle is competing through database integration, bare metal performance, and large NVIDIA clusters. AWS still wins on revenue, profit, and total market share. But Google and Oracle are winning on growth. Azure is closing the scale gap, and every major provider is designing more of its own hardware. This is no longer simply a cloud computing competition. It is becoming an industrial battle over chips, energy, data centers, and control of the AI platform. Amazon's strategy works because four businesses reinforce one another. The first pillar is core e-commerce. North American operating profit reached $9.1 billion, supported by regional fulfillment networks that reduce delivery distance and lower cost per package. Amazon also maintains aggressive pricing, while Amazon Business has grown beyond $60 billion in annual sales. The retail operation attracts customers, merchants, and purchase data at enormous scale. The second pillar is advertising and Prime. Advertising generated $19.8 billion this quarter, with margins far above physical retail. That profit allows Amazon to preserve low consumer prices, strengthen Prime, and fund research across AWS and AI. This is Amazon's cross-subsidization engine. Retail creates demand, advertising monetizes that demand, and the resulting cash supports infrastructure investment. The third pillar is AWS and AI. Its $496 billion backlog provides years of contracted demand, while the custom silicon business has surpassed a $25 billion revenue run rate. With most global IT workloads still operating outside the public cloud, Amazon believes the migration opportunity remains enormous. The fourth pillar is capital allocation, and this is where the risk becomes visible. Reported EPS was $5.75, but estimated core EPS was closer to $1.19 after removing the Anthropic valuation gain. Free cash flow fell below zero, while annual CapEx guidance climbed toward $220 billion. Amazon possesses several powerful growth engines, but their long-term value will depend on whether the return from AWS and AI can eventually exceed the cost of building them. Amazon's 2030 thesis begins with the largest capital cycle in the company's history. Annual CapEx could rise from roughly $132 billion to approximately $300 billion by the end of the decade, with an estimated 70% directed toward AWS infrastructure. That investment could create enormous computing capacity. It will also create what analysts describe as a depreciation wall. Servers, networking equipment, and data center hardware do not disappear from the income statement after they are purchased. Their cost is recognized gradually, potentially pushing annual depreciation toward $160 billion to $180 billion by 2030. Amazon must therefore keep its infrastructure highly utilized. The $496 billion AWS backlog is critical because contracted demand can help fill new capacity, spread fixed costs across more customers, and protect margins as depreciation rises. The second layer is technological control. Trainium and Inferentia are designed to reduce Amazon's reliance on expensive third-party GPUs. Amazon's roadmap also depends on TSMC, ASML, and the broader semiconductor supply chain delivering enough advanced manufacturing capacity. Project Kuiper could eventually extend Amazon's infrastructure through satellite connectivity, creating another link between computing, communications, and enterprise services. The long-term opportunity is shifting from AI training toward inference, the repeated execution of AI models after they have been deployed. Inference could eventually represent roughly 75% of AI computing demand, making cost efficiency more important than simply owning the most powerful chip. The valuation case then depends on Amazon's other businesses acting as financial ballast. Advertising revenue above $60 billion and retail activity exceeding $580 billion could stabilize the company while AWS absorbs the investment cycle. Under the bullish scenario, recovering free cash flow could support a valuation approaching $3 trillion and a stock price near $500. But the path is not guaranteed. Underutilized data centers could become stranded assets. Power constraints could delay expansion. Google could force an industry-wide price war. Regulators could fragment Amazon's ecosystem. The opportunity is exponential, but so is the cost of getting the investment cycle wrong. Amazon's cost structure reveals exactly where management is placing its bets. Technology and content expenses have compounded at approximately 13% annually, while fulfillment costs have increased at a similar rate. These are the two areas Amazon needs to expand in order to support AI infrastructure, faster delivery, and a larger marketplace. Selling and marketing has grown much more slowly, while general and administrative expenses have declined slightly over the period. That distinction matters. Amazon is not allowing corporate overhead to rise at the same rate as the company's strategic investments. Total operating expenses reached approximately $77.4 billion this quarter. Technology and content accounted for $33.2 billion, while fulfillment contributed another $29.6 billion. Amazon is spending aggressively, but most of that growth is being directed toward computing capacity and logistics infrastructure rather than administrative expansion. That is disciplined spending, although it is certainly not low-risk spending. Amazon's transformation becomes clearest in its bottom line. In Q2 FY22, the company generated $121.2 billion in revenue, but still recorded a $2.0 billion net loss, producing a negative 2% margin. Over the next 3 years, stronger AWS profitability, a more efficient fulfillment network, and the rapid expansion of advertising steadily pushed margins into double digits. By Q1 FY26, net income had already reached $30.3 billion, with a 17% margin, evidence that Amazon's underlying earnings engine had fundamentally changed. Then Q2 FY26 delivered the dramatic headline: revenue of $200.6 billion, net income of $62.6 billion, and a reported margin of 31%. But that final surge was heavily amplified by the Anthropic fair value gain. The lasting story is not the temporary 31% margin. It is Amazon's shift from losses to structurally stronger profitability across retail, advertising, and cloud. Amazon has exceeded Wall Street's revenue expectations in 8 of the last 9 quarters. The only miss came in Q2 FY24, and it was extremely small. Every quarter since then has come in above consensus, demonstrating that Amazon's revenue execution has become increasingly predictable despite the company's enormous scale. The strongest surprise came in Q2 FY25. This quarter extended the streak, with revenue of $200.6 billion compared with an estimate of approximately $197 billion. The significance is not the size of any individual beat. It is the consistency. Amazon is now entering each quarter with multiple independent growth drivers: marketplace activity, advertising, subscriptions, logistics services, and AWS. Weakness in one area can increasingly be offset by strength elsewhere. Analysts currently expect the holiday quarter to approach $244 billion, with quarterly revenue remaining above $200 billion through much of FY27. The market is no longer debating whether Amazon can reach this scale. It is debating how profitable that scale can become. Amazon's earnings surprises have been considerably more volatile than its revenue results. Most quarters have exceeded expectations, although Q4 FY25 produced a slight miss, with reported EPS of $1.95 compared with a $1.97 estimate. The following 2 quarters moved sharply in the opposite direction. Q1 FY26 delivered EPS of $2.78 against expectations of $1.63. Q2 then produced the extraordinary $5.75 result compared with a consensus estimate of $1.82. But investors should not extrapolate that figure into future quarters. The majority of the surprise came from the Anthropic fair value gain rather than a comparable increase in operating profit or free cash flow. That is why forward estimates immediately return to roughly the low to mid $2 range. Amazon's core earnings power is clearly improving, but the reported Q2 figure dramatically overstates the normal quarterly run rate. The next question is whether the stock's valuation already reflects that distinction. At the time this forecast was captured, Wall Street's average 12-month price target for Amazon stood at $326.67. Implying approximately 15% upside from a share price near $284. The range of outcomes is unusually wide. The most optimistic target reaches $400, while the lowest estimate falls to $230. That spread reflects the central disagreement surrounding Amazon. Investors broadly agree that AWS and AI can produce enormous revenue, but they disagree on how much capital Amazon must consume before that revenue becomes free cash flow. Analyst sentiment remains strongly positive. Of 69 recorded ratings, 56 classify Amazon as a strong buy, 11 as a buy, and only 2 as neutral, with no sell recommendations shown in the current dataset. But the investment case ultimately comes down to one equation. Amazon has a dominant marketplace, one of the world's strongest advertising platforms, the largest cloud infrastructure business, and a rapidly expanding custom silicon ecosystem. Against those advantages stands an investment program approaching $220 billion per year, negative free cash flow, and a future depreciation burden that could place significant pressure on margins. If Amazon converts its backlog into highly utilized AI infrastructure, today's spending could establish the foundation for another decade of compounding growth. If utilization falls short, the same infrastructure could become one of the most expensive overbuilds in corporate history. That is what makes Amazon's Q2 FY26 report so important. It was not merely a strong quarter. It revealed both sides of the company's AI bet: extraordinary demand and extraordinary financial risk. Everything discussed in this video is based on publicly reported financial information, market estimates, and sources considered reliable at the time of publication. This content is provided for informational purposes only and does not constitute investment advice. Investors should always conduct their own research before making any financial decision. Thank you for watching. If this analysis helped you understand what is really driving Amazon's results, consider liking the video and subscribing for the next earnings deep dive.